Hello everyone, and welcome back to the channel. Today, we are covering the final step of the accounting cycle, which is closing entries. Without further ado, let's jump right in. To understand closing entries, we must first look at retained earnings. Revenues, expenses, and dividends are all components that impact retained earnings. As we discussed in our previous videos, the retained earnings account is reported under the shareholders' equity section of the balance sheet. Revenues, expenses, and dividends are known as temporary accounts. Their balances are not carried forward into the next accounting period. Instead, we reset these balances to zero at the end of each period to accurately capture the data for the upcoming period. Conversely, all balance sheet accounts, assets, liabilities, and shareholders' equity are permanent accounts. Their balances always carry over. Before we look at the journal entries, keep these 4 rules in mind. Closing entries transfer the balances of temporary accounts directly into retained earnings. Prior to closing, the retained earnings account only shows its beginning balance for the period. We use a temporary clearing account called the income summary to close out revenues and expenses. The final balance in the income summary account represents either the net income or net loss for the period. We accomplish the closing process in 4 precise steps. Step 1. Close revenue accounts. Revenues have a normal credit balance. To clear them, we debit each individual revenue account and credit the total amount to the income summary account. Step 2. Close expense accounts. Expenses have a normal debit balance. To clear them, we credit each individual expense account and debit the total amount to the income summary account. Step 3. Close income summary to retained earnings. If revenues exceed expenses, the income summary will have a credit balance, representing net income. To close it, we debit income summary and credit retained earnings. If expenses exceed revenues, we have a net loss, and the entry is reversed. This leaves the income summary balance at 0. Step 4. Close dividends declared to retained earnings. Dividends have a normal debit balance. We credit dividends declared to reset it to 0 and debit retained earnings. Remember, dividends are distribution of earnings to shareholders. They are never classified as an expense. Let's look at a practical exercise to see this in action. Assume DT Company has the following adjusted trial balance figures on October 31, 2026. Service revenue, $20,000. Salaries expense, $5,000. Supplies expense, $1,000. Rent expense, $1,000. Depreciation expense, $800. Insurance expense, $80. Interest expense, $40. Income tax expense, $1,500. Dividends declared, $500. Here are our 4 journal entries. Entry 1. We debit service revenue for $20,000 and credit income summary for $20,000. Entry 2. We credit every individual expense account listed above and debit income summary for the total sum of $9,420. Entry 3. To find our net income, we subtract total expenses from total revenues, $20,000 to $9,420, giving us a net income of $10,580. Because it is a net income, we debit income summary for $10,580 and credit retained earnings for $10,580. Finally, we close our dividends. We debit retained earnings for $500 and credit dividends declared for $500. With those 4 steps complete, our temporary accounts are reset to 0, and our retained earnings accurately reflect the company's new financial position. Thank you so much for watching. If this video helped you understand closing entries, please give it a thumbs up and subscribe for more Canadian accounting tutorials. See you in the next video.